Hello and welcome to the i3 podcast. My name is Wouter Klein and I'm the Director of Content for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3-invest.com. There you can also subscribe to our complimentary newsletter i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice. Please enjoy the show.
Welcome to the i3 Insights podcast. My name is Daniel Grioli and I'm the MarketFox columnist for i3 Insights. Today I am joined by Stephen Gilmore. Up until April 2018, Stephen was the Chief Investment Strategist for the Future Fund. That's Australia's $140-odd billion sovereign wealth fund. Over the last 10 years, the fund has delivered an annualized return of 8.5%, beating its benchmark target of 6.7%. We're going to cover a lot of interesting topics today, including the challenges of creating and leading a single multi-asset investment team, how scale affects investment strategy, and some very interesting war stories about working in countries in the middle of a civil war and some of the more famous financial debacles that have happened in the last 20 years or so. Stephen has had a long and varied career, including stints with the Reserve Bank of New Zealand, Chase Manhattan Bank, working with the IMF in some far-flung places, with Morgan Stanley and AIG during the global financial crisis. I can't wait to chat with Stephen about this. So without further ado, I'd like to welcome Stephen to the podcast. Stephen, thanks for joining us today.
Thanks, Daniel. It's a pleasure.
So we usually start by asking our guests a little bit about their background and how they ended up in finance and investing. What's your story?
Well, I started out studying economics, and at the end of my degree, I had the opportunity to take up an assistant lecturing role in finance at Otago University in New Zealand. They took a bit of a risk. They wanted an economist, and I went there. So I got dropped in it that way, which was great because they didn't really expect me to know a lot about finance. I learned, and I had the privilege of spending some time with one of the visiting professors, Simon Beninga, who ended up being, the author of one of the main texts for financial modelling. So that was a privilege and a pleasure.
Okay, very interesting. So why did you decide to move on to working in markets rather than a career in academia?
It's a good question because it was comfortable, it was quite enjoyable, but it wasn't really that challenging. In New Zealand, you're a long way away from everywhere, and if you want to proceed, you really have to go to places like the States to do doctoral work and so on. I just really wasn't up for that. I instead moved across to the Reserve Bank, and that was a fascinating time because New Zealand was going through a process of rapid economic reform. The currency had been floated, capital controls had been lifted, a lot of economic reform. So it was an exciting time, and I joined the Reserve Bank, and we got to basically think about things from first principles. It was quite exciting intellectually.
So you mentioned the influence of working with Simon Beninga at the University there of Otago. Were there any other people that stood out in the early days as mentors and key influences?
Well, I think I'd have to mention Lowell McLean, who was a professor at Otago. He took the risk. He brought in an economist into accounting and finance, so very much appreciated that. The Reserve Bank had a lot of interesting thinkers, a lot of very young people who were basically let loose just to do stuff. And I think one I would highlight would be Mark Swinburne, who was extremely good on the economics and policy side. And I also had the pleasure of working with him at the IMF as well. So he was a great thinker, but sadly passed away all too soon.
Okay, that's sad. So you've had this great experience at the Reserve Bank of New Zealand. How did you make your way from there to the IMF?
A lot of people in New Zealand end up travelling. They do their OE, their overseas experience. I took a year's leave of absence from the Reserve Bank back in the late 80s, and I never ended up going back. So I bought a one-way ticket to Asia, made my way to London, picked up a job with Chase Manhattan. And again, they took a risk. They brought me in and dropped me into a derivative structuring role. I hadn't really done much of that. So I appreciate particularly people like Sykes Welford who took that risk and ended up eventually moving into a dealing room, doing fixed income structuring, then moving across to FX options for a while. That was an experience.
Okay, so now you've got more of a capital markets experience under your belt, actually working with an investment bank. So I see from your CV you then ended up in Washington with the IMF.
Yes, it's a long story. I wanted to get to Paris for personal reasons, but ended up chatting to someone in Washington. They said, "Come and work for us. The Soviet Union has broken up. We need people. It's really interesting. If things go well, you may be working on former Soviet countries in a year." It sounded, again, quite interesting to me. So I applied. I got accepted. I joined. And within a month, I was in Minsk, so working in Belarus. And again, fascinating times.
Mm-hmm. So it sounds like they overestimated when they said within 12 months, because you were there within one.
Oh, it was hectic. The IMF had created a new department. There were 15 new countries from one. For the most part, they didn't have the infrastructure. They had to develop new institutions, central banks, finance ministries, which had all been branches of the centre before. The way of thinking about things was very different. Weren't experienced in market economy. So it was almost all hands on deck, and we were travelling a lot to these places. And it was fascinating to think about some of the contrasts. I still remember being in the central bank, National Bank of Belarus, when someone plucked up the courage to just ask the question. They said, "We've heard that in the West, bankers get paid more than factory workers. Is that true?" It was just so different.
Okay. So you've been at the IMF for 1 month. You haven't even finished your probation, I presume. You're now in Belarus. What were you doing there?
Institution building. So we were working with the central bank, basically helping them to set up their legislative framework. We would be working on FX reserve management, monetary policy implementation, accounting, the whole range of things that central banks might want to do when they start up.
Okay, so it sounds like you started from a blank sheet of paper.
Almost. I think having been at the Reserve Bank helped a lot because it was a small organization, so you got exposure to a lot of the different areas.
And in terms of the people you were working with over there, what things stood out about, you mentioned they were surprised at the salaries that bankers earned. Were there any other things that stood out to you in terms of how different their knowledge and where they were at was compared to countries in the Western world? So?
I would say that banking was perceived differently. It was really more an accounting function, and most of the good people within the banks were actually women. Often they didn't hold the very top positions, but it was quite female-dominated. It had a different, perception. So it wasn't really about being creative, innovative. It was more about being technocratic, and there were some very good people in that field.
So you're now in Belarus, and tell us how you get from Belarus to Tajikistan and what it was like there and the circumstances at the time.
Okay. Most of the time I was at the IMF, I was working on countries of the former Soviet Union. And that meant working in places like Belarus, Russia, Georgia, Turkmenistan, and a few others. As time progressed, I moved across to a country desk. I worked on Armenia, and I was closely involved with the Armenian program with the IMF. But the IMF encouraged people to take on resident representative roles. So to actually spend some time in the country, and that was also something that sounded quite appealing to me. So I let them know that I would be interested in taking up a role if one became available. A little while later, the person who oversaw the program mentioned to me that, there might be a role in Tajikistan. Of course, I didn't know much about Tajikistan, so I thought, I'll chat to some people who've been there. And so I talked to...
Could you find any?
I could. There were some people in the IMF who'd been there, but also some people at the World Bank. And everyone spoke very highly of the place, the people. And I went back and let people at the IMF know that I would be interested. The only requirement they gave me was that I find someone to take over the Armenian role, and I did that.
Okay. So you're in Tajikistan. Tell us what it was like. Fascinating.
It's actually a wonderful country, beautiful scenically. 93% of the country is covered in mountains, so rivers. As I say, naturally beautiful, quite hard to get to, or it was then. Fascinating culture. Revere poets, interesting music. The main streets in the capital are named after poets. Of course, when I went there, it was also quite challenging because the civil war was ongoing. Something like 100,000 people may have been killed during that war. And just to give you an idea of how bleak it was, there were close to 1 million refugees from Tajikistan in the relative safe haven of northern Afghanistan.
That I think that says something if Afghanistan is a safer place to be. So how did the civil war impact your life while you were living there and your work with the IMF? Did you have to take precautions?
It may sound a little bit ironic, but I'd lived in Washington, and in the 90s there were some parts of Washington which were quite dicey. And there were times when I actually felt safer in Dushanbe than I might have in Washington. It felt more predictable, and that probably wasn't the case. I was probably naive. But it just felt a little bit more manageable. What it did do, though, was mean that you had to focus quite a lot on the realpolitik. There were just certain things that policymakers couldn't do. They didn't have control over swathes of the country. Defense was really important. There were times when you'd be subject to threats. At one point, one of the warlords surrounded the central bank where I had my office. Had about 50 people, came in and made a withdrawal. That was a little bit daunting. There were things like bomb blasts and the like. But for the most part, we just got on with life.
Well, that's something that we're unlikely to hear about at the current Royal Commission. When people turn up and warlords summarily demand their savings from the central bank, or probably not even their savings. So it sounds like an interesting time. And what sort of work were you doing there? Was it more of the same, helping them build institutions from the ground up?
It was a combination. Before I went to Dushanbe and Tajikistan, my boss at the IMF had said, look, you're there to work with the people. You're not there to be part of the diplomatic community. And I took that to heart. So I was really there to help with institution building, which could be helping develop the implementation of monetary policy at the central bank. I was also a conduit or a liaison between the IMF and the authorities in Dushanbe. So a lot of the focus was on implementing a financial program with the IMF. One of the biggest challenges that the Tajiks had faced at the time was how to feed the population. Of course, there's a war going on, a lot of displaced people, a lot of emphasis on providing low-cost bread. So bread was subsidized, which meant that the authorities would take resources from the cotton and aluminium sectors. They would use that money to buy grain offshore. They'd bring it in. They would bake all this bread, cheap bread, which would be rationed, low quality. And of course, it disrupted the budget. It disrupted the cotton sector, the aluminium sector, and it also depressed prices for potential wheat growers in Tajikistan. And one of the things that the IMF typically recommends is sort the budget out and get rid of these subsidies. And we pushed very strongly to have the authorities remove subsidies for bread. And of course, they were very anxious about that because in some countries that leads to riots and not surprisingly, but the authorities grasped the task. They did do that. the timing was such that food aid came in from the European Union, the US, helped smooth the transition. And the whole process went incredibly smoothly. Prices were liberalized, compensation was paid to the poorest. Because prices for wheat rose, domestic production soared. And the authorities saw that the market can work. It was a huge lesson in terms of the reform process, and it set the scene for future changes to come. And future changes had to occur. I mean, inflation was 2,000% at the time. That was brought down to around 40% the following year through an exchange rate based stabilization program.
Okay, so how do you create financial markets in an environment like that?
The people there were quite entrepreneurial, so creating markets wasn't that difficult. A lot of currency trading went on, black market trading. Even during the Soviet days, I met quite a few people who had traded actively, Tajiks who had traded actively. They'd managed to source certain things in Russia, and they would be bringing them back, and they would be stripping off various fruits from Tajikistan. So the trading mentality was always there. It was really more about the infrastructure.
So after your time with the IMF, you moved on to Morgan Stanley, and we were talking offline about some of the things you did there with the Russian Republic. About the time that it defaulted on its bonds. Tell us about that story.
Well, I think I put this down to the lessons I've learned through time, and that was probably the second one. I think going back, you tend to think of the market crises that you've experienced, and for me, the very first one was back in 1987 when the stock market dropped a lot. I was at the Reserve Bank of New Zealand. I was actually at a course in BAL, the BIS, for bank supervisors. And it was intriguing just to see, the degree of activity that was occurring at that time as the market was plunging. Of course, I was quite interested in my own little portfolio back in New Zealand. High beta stocks, couldn't get any information. It got vaporized. So that was quite a lesson in terms of not being able to get the information, and also a lesson on, what happens when you see these periods of market turmoil. But then coming to Morgan Stanley, I went in as a European time zone emerging market strategist. So it was my job to think about Russia. And so I was spending quite a bit of time looking at, the domestic and external macro position, trying to work out whether the currency would depreciate, whether it would be a default or so, or what would happen. And of course, I got it wrong. I didn't anticipate that combination of events that occurred. And it's also quite humbling when you've written stuff, you're making a fairly bold call, and you get it wrong. You're held to account in terms of the perceptions and your own call. And lots of lessons came from that. One of them was that we probably had enough information in the organization to be much better in making that call. So sharing the information, I think, was quite important. I think also there were certain signs, that occurred in Russia. For instance, when the savings bank stopped purchasing, domestic debt, you should really have known that the time was up. So that I think was quite informative for me. I think beyond that, there were other things, and that was, what are the consequences of this? And it went well beyond Russia. So of course, the knock-on effects were quite large. One that gets highlighted, I guess, is LTCM. When positions get stopped out, there can be chain reaction. So it was quite important to think about what else can happen, and that was really thinking about people's positioning, risk management, and what the implications of certain events would be. Don't just think about the initial event. Think about the implications of that event.
So it sounds like you learnt two important lessons there. One was the need to communicate and integrate within the organization, because, as you pointed out, a lot of the information that you needed to get the call right probably resided in the organization already. And the second lesson that you highlight there was the need to think beyond the actual event itself and think about the second and third order consequences. How have those two lessons changed the way you invest?
Well, I think it's almost self-explanatory. The process needs to be collaborative. You don't know who's going to have the right information, who's going to be asking the right question, but be open to that input. And the same goes for thinking about the consequences. If it's logical, linear, someone's probably thought of it. It's much more interesting to think about those things that are more lateral. To step back and think big picture. What does this mean?
Do you think investment organizations generally do that sort of thinking well or poorly?
I think they probably do it quite poorly. Often they tend to be siloed, and they tend to be focusing on narrow rather than the big picture.
Okay. We're going to pick up on some of these themes a little later on when we talk about integrated whole of portfolio approaches to managing money. So you've moved on now from Morgan Stanley to AIG, and you're in London as a strategist with the financial products team. And for our listeners that don't know, this team is the team that was at the epicenter of the derivatives fiasco that almost brought AIG down if it wasn't for the US government bailing them out. So tell us about what it was like to work at AIG at the time when all of this was happening.
Well, I worked for Bank AIG, which was the the European arm of AIG Financial Products. And AIG Financial Products had a very interesting background. It was started by people who'd come from Drexel and Bell Labs, very intellectual type of organization, quite small. It had been highly profitable through time. So it was quite cerebral. And the London team, around 100 people, well, probably fewer than that when I joined, was very collaborative. It was actually a great little environment to work in. The person who ran it became quite infamous, and that was Joe Cassano. I had a lot of time for Joe. Very smart guy, quite a moral guy, but he was quite volatile. So he could be really up or he could be really down, and his, mood affected things. But what he did do was force a great deal of collaboration. So if there was a business imperative, people worked together, and they worked together, I think, very, very effectively. So it was actually a good, place to be in terms of the culture. Of course, looking back on it, you can point to all the deficiencies, and lots of lessons arose from the experience there. And probably the first thing that stands out to me relates to leadership. I thought a lot of Joe, but the reality is that no matter how good someone is, they can make mistakes, and some of those mistakes lead to unintended consequences again. If you think about AIG as a whole, it had been made successful by Hank Greenberg. And he was ousted in 2005 as part of Elliot Spitzer's efforts. And I think that if Hank had remained in charge of AIG, there would not have been a need for a bailout, because he was much more focused on the risk side of things. That's, I guess, my assumption. I could be wrong, but I had this feeling that if those changes hadn't occurred at the top, then AIG wouldn't have been in a position to have had so much risk and to have needed that particular bailout. I think also there are lessons with respect to liquidity, and it's kind of ironic. The one thing that Joe was adamant about was that he didn't want to write liquidity puts, so he didn't want to be a liquidity provider for the rest of the market. But of course, that's actually what happened in the end. AIGFP had written a lot of super senior CDS protection, and ultimately faced margin calls on that protection that had been written. But the sequence of that process was was fascinating because when AIG was AAA, I don't believe that it was vulnerable to having to post collateral. But as AIG got downgraded, some of those potential collateral calls got triggered. And of course, as the underlying instruments fell in value, then margin calls could be made. And it was more complex, of course, because a lot of the valuations for these instruments were essentially mark to model rather than mark to market. So you could see this whole process of a downward spiral as things fell in value, more margin calls occurred, and it just became self-fulfilling.
I couldn't help but think while you were discussing that the environment at AIG, what it must have looked like when they realized that the game was up, that there was a lot more risk there than they thought was there. Was it something like the 7 stages of grief? Did they go through shock, denial, pain, guilt, anger, bargaining, depression, reconstruction, acceptance, and hope? Was it that sort of a roller coaster of emotion? Or?
I don't think it was. I think back in 2005, there was a recognition that there was perhaps more risk on than may have been prudent, and at that point, an effort was taken to hedge some of that risk. And of course, what happened? The hedge was put on, a small hedge was put on, and the market kept rallying, so the hedge lost money. I think one of the the fascinating things here about thinking about that is that you've got to think about the incentive structure. If AIGFP had been in a position to fully hedge all of its exposure, it just wouldn't have generated the revenue, and it would have lost its people. So the business would have been undermined. And I think quite a lot about those incentive structures, because on the one hand, you had people whose compensation was in large part, for some people, deferred. So it had quite a model incentive structure whereby people were aligned to the well-being of the business. Yet even with that, mistakes can be made, and even with that, people could still be incentivized to keep the risk on. So in this particular case, there was a recognition that there was risk. There was an attempt to do something, but very small, and then it was a case of really saying, okay, there's risk on, but we have sufficient liquidity, and then monitoring that liquidity very closely. But of course, the situation can change, and the repo market froze up, so funding became very, very difficult. And then in the end, AIG required a bailout. Interestingly enough, that bailout, which was quite penal, ended up making quite a bit of money for the US government, for the Fed and the Treasury. I think they benefited to the tune of $20-odd billion, which I guess really highlights the point that it was more likely a liquidity problem than a solvency problem. And of course, it wasn't just AIGFP. It was also the investment arm, which had been involved in securities lending. So there were 2 main contributors to the stresses that AIG faced.
I think there's some very important lessons in your comments, particularly around the role that the incentive structures played, that they actually, even though they were aligned with the longer term performance of the business, they made it hard to manage risk by hedging, because it meant people weren't getting paid, and then you have the issues of staff leaving potentially, and other things related to that. And also your points around the impact of liquidity on markets, that sometimes your positioning may not be wrong, and it sounds like in the fullness of time AIG's positioning proved out to the benefit of the government that bailed them out. It's just that they couldn't last because of the amount of leverage they had on the books.
I think there are lots of lessons, and I still think about the lessons. I think that I would conclude that the positioning was wrong because it couldn't last. I think there was also another lesson there in terms of failing. You don't want to be the first or second organization. It became easier for others later when the issue was more systemic. best, of course, is to not get into that position of vulnerability if you can avoid it.
That reminds me of Roger Lowenstein's book on the crisis, where he writes in great detail that all of the key players thought that Lehman Brothers going under wouldn't be as big a problem as it was, and that it might actually scare the other players straight. And when they realized that they'd miscalculated, as you were alluding to, they were much more prepared to bail people out significantly and quickly when they realized that this was getting out of hand.
Yeah, well, it's interesting. When I first started at the Reserve Bank in New Zealand, my role was to look at capital adequacy and banking supervision. And the joke was always that, well, really, you wanted, if there was to be a bank failure, you wanted it to be a small bank, which didn't have any systemic issues, but had a demonstration effect and improved risk management elsewhere. But of course, it's very hard to judge what's small, because there can be that contagion. It was also quite intriguing just to think about how nasty the environment became. Because again, thinking about incentive structures, what AIGFP did was arrange a whole lot of retention agreements with staff to make sure that people didn't leave. This is from 2000 and early 2008. They wanted to make sure that the business could still function and people had deferred payments. And of course, after AIG was bailed out by the government, these arrangements became highly controversial, and it led to death threats to some of my colleagues. It also meant that some people had to go into hiding. They took people their kids out of schools. So it was quite I guess a reminder about social license and I guess the public implications of some of the events that were occurring.
Okay, I didn't realise it went that far for the families of some of the people involved.
Yes, some people organised coach tours of properties in Connecticut, where you could go and visit some AIGFP staff members' houses.
I'm interested to get your thoughts on the role of risk modelling at the time, because a lot has been said since the crisis on over-reliance on things like value-at-risk modelling and overconfidence based off sophisticated quantitative techniques. Do you think that played a role in what happened at AIG?
It was a special time. This was a period where people were constructing all sorts of securitized instruments, credit instruments. The rating agencies were heavily involved. So there's a lot of focus on modeling and historic relationships and historic outcomes. And when that happens, people can be a bit myopic, I think. They focus on the history, they focus on the micro, and sometimes they don't necessarily focus on the big picture. And I think when it comes to things like residential mortgages and subprime and incentives, that was the case. It's a little bit different when you're looking at corporate credit. So absolutely, I think people spend too much time thinking about the models and maybe not exercising as much judgment. Likewise, at the time, these credit spreads were being driven down to incredibly low levels. Super senior credit exposures were trading at very, very, very low spreads. And even if it was hard to think about possible outcomes where there would be defaults, you can't say that there's no chance of there being defaults. So it just looked bubble-like. But the machine kept on churning these things out.
It's very thought-provoking to hear you speak about the importance of actually thinking about the risks and not over-relying on the model, because it sounds like from what you're saying, the model can only take you so far. And after that, you've got to be quite thoughtful about the risks that you manage.
Absolutely. But there's also the technicality related to it as well. A lot of these arrangements had lots and lots of documentation. And, it's not always clear that people have gone through all that documentation and, know all the detail of it. And, these transactions are being done at a fairly rapid pace. So it becomes machine-like. But sometimes it's just very helpful to step back and to think about, does this make sense?
Okay, so you've gone from political drama, war, financial markets drama, and now you're at the Future Fund in 2009. How did you come to join the Future Fund, and what was it like? Because that was very early on in its history.
Well, obviously with what happened with AIGFP, it went into wind down. And so I, of course, needed to find something else to do. An opportunity arose at the Future Fund. I think they viewed me as an opportunistic hire. And I'll be forever grateful to Paul Costello and Dave Neal, Tony Day, and Craig Thorburn, who were all took the risk, got me in. And for me, having come through the AIGFP experience, it was actually quite important to have a role that had some meaning, and to be sitting there investing for the Australian taxpayer actually had a fair degree of meaning. Also, personally, it was closer to family and friends in New Zealand, which also helped. And I think the role was one where you could bring everything together. You could look at the macro, the markets, the politics, and think about what that meant for the portfolio. So it seemed like the culmination of all the things that had come before. So, almost an ideal type of role and environment. And at the time, the macro political backdrop was quite intriguing, as you will recall, 2009. And the Future Fund itself was quite small in terms of staff numbers. And a lot of focus was on getting invested. And that became a main emphasis. How much risk should we have? Where should we put it? What can we get? And the opportunities were there in those days. So it was really more about the capacity of the organization to be able to implement those investment opportunities.
In some ways, it's almost the flip side of AIG, because there you were with the positions on, and then you got hit for not having liquidity, whereas at the Future Fund, you had the liquidity because you've been funded by the government, although there was a decent whack of Telstra shares that I think you were stuck with for some time. So you had the liquidity, and you also had the spreads that had blown out because of the crisis. So lots of opportunities and lots of money to deploy.
Well, that's true, but some of that was also some good decision making. Early on, the aim of the Future Fund had been to take the equity exposure up to around 70% or so. But in 2007, people at the fund just thought that didn't really make sense, given the background risks and given the rewards. So the build of risk in the portfolio was halted. So the fund went into the financial crisis with an equity exposure of around 25-26%. So it did have the ability to invest when the markets fell. But of course, it does take some courage to actually make those investments when there's blood on the streets, so to speak.
Sure. Was there a bit of pressure politically to get invested? Was there pushback about why are you sitting on all this cash?
Well, I didn't see the discussions in late 2007, 2008. But certainly in 2009, there was a lot of debate, when the market started rallying, about how best to get that exposure, which is what you'd expect.
That's right. It is tough to hold your nerve when the buying is the cheapest. So our very first podcast guest was Professor Keith Ambachtsheer, and he's a big advocate of pension funds managing assets in-house. The Canadian funds that he does a lot of work with do have very large in-house teams. And during our podcast conversation, Keith mentioned that the Future Fund, which typically outsources investment management to fund managers, could be sacrificing as much as 1% a year, which is a big number in a low return environment, by not managing money in-house. So as somebody who worked with the Future Fund in a very senior strategy role, what's Keith missing?
I think it depends very much on the organisation and where you're getting those excess returns and what you're paying the managers. I very much doubt that the Future Fund could generate an extra 100 basis points by having everything insourced. A number of considerations here. You can look at other organizations, and you might want to compare Harvard versus Yale. Yale's typically outsourced. Harvard had done a lot of insourcing, but is now changing. Clearly, the people at Harvard don't think there's 100 basis points extra in terms of doing things internally. And I've also looked at this as a context from the future fund versus, say, New Zealand Super, when New Zealand Super insources more and actually pays lower fees. When I look at the excess returns generated over liquid proxies, they're about the same. It's just that the models are somewhat different. One lower fee, more insourcing, one higher fee, outsourcing. I think what's really important is you don't pay fees on stuff that's easy to do. So if it's just generic beta, if it's alternative beta, you shouldn't be paying very much. And if you're paying those fees, you're doing it because someone is providing some skill or insight. Also, there are some things which, if you were to insource, let's say, some of the derivative overlays and so on, you would need to build a much different infrastructure. You would need to have 24-hour trading capabilities and so on. I would think that if you were to insource things like private equity and venture, and again the derivatives trading, you run the risk of changing the incentive structures and the harmony within the organization. You'd have to pay people differently, and that could adversely affect the culture. And
that was very much the experience with Harvard, wasn't it? A lot of people complaining about how much the internal team got paid.
Well, in the end, if the internal team gets paid a lot, and as an organization you're not doing well with respect to your overall objectives, it just doesn't add up. Mm-hmm. I think it's much more important to achieve the overall objectives.
Okay. So it sounds like it's really horses for courses when it comes to things like insourcing versus outsourcing.
Absolutely.
Okay. So moving on to another question relating to the Future Fund. We see that Peter Costello, the former Australian Treasurer and current chair of the Future Fund's Board of Governors, has made comments in the media suggesting that Australians would be better off if their superannuation was managed by the Future Fund. What do you think?
Well, I think Peter's making those comments, from a personal perspective, and of course it's quite understandable. If you look at it historically, the Future Fund has done pretty well. I think it's important to think about what might happen in the future in terms of if the Future Fund were to be managing those funds. I think the first thing that comes out, of course, is scale. Could the Future Fund generate the same sorts of returns if it were to be a couple of trillion? I really don't think it could, given the current model that it has, given the opportunity, because the larger you get, the more like the market you become. I think also, this is something that the Productivity Commission has been thinking about, and, it considered whether the Future Fund could potentially do this, but thought that there were, incentive reasons not to do that. I think, one of the points they highlighted was that, if an organization like the Future Fund were to do it and it performed poorly, there could be an implicit obligation for the government or the taxpayer, to bail, the fund out, or to bail the beneficiaries out. But I'm kind of open. I mean, I think, ultimately you want an arrangement which is best, for the end beneficiaries. But if funds were to be managed by the Future Fund, I think the structures would have to be somewhat different. The portfolio would be different. You wouldn't want to have probably the same board looking after the existing Future Fund versus some sort of default arrangement. But I think this debate will continue, particularly given the Productivity Commission report and given the Royal Commission and so on.
One of the things I note that happens a lot with this debate is there's often the media compares the raw returns of Future Fund and the superannuation fund, and what they forget is that the Future Fund doesn't pay tax, whereas the super fund's returns will often have accrued tax subtracted from them. So something to be careful of in the debate is making sure that you're making apples for apples comparisons.
Or even when those adjustments are made, the Future Fund still stacks up pretty well.
The Australian media loves to report about the Future Fund. A particular favourite of the media seems to be the level of cash that the fund holds. There's always these apocalyptic, the Future Fund is sitting on 30% cash, this means the market is going to crash headlines. What's the real story?
Well, I think the cash is a bit lower than that now. But I think the real story is that you should look at the overall risk within the portfolio. So there are times when the future fund's portfolio probably would have similar risk characteristics to a 60 equity, 40 bond portfolio, even though it's got a lot of cash. And people aren't going to talk about a 60-40 portfolio and say that's not necessarily risky enough because you're being very defensive. So I think, first thing, look at the overall risk. The future fund would have a lot of exposures which are riskier than average. So some of the private equity exposures, venture, the debt in the portfolio is higher risk than traditional fixed income. So the cash can be there at times to offset higher risks in other parts of the portfolio. Likewise, there was a feeling that by having higher risk assets and cash, having that barbell, you have a portfolio that's more flexible than would be the case if it was just like average risk assets. And focus was also attached to the option value of that cash, or the option value associated with portfolio flexibility. So I wouldn't focus too much just on that cash number. And I guess also in an environment where bond yields are still relatively low, cash isn't that far away from a bond.
I think your comments there about the option value of cash were really brought home by the future fund's early experience and not being fully invested and having a low equity weight and having that cash during the 2009 period. So we can see why the fund really prizes that option value.
Absolutely, but of course it's very hard to time the markets, and then you've got to have the right governance arrangements in place to effectively use that flexibility at the right time.
Okay, I think that's a good segue to talking more about the team and how you manage money at the Future Fund. And we mentioned earlier this idea of a whole of portfolio approach managed by a single team. The Future Fund operates that way. Why did they make the decision to organise the fund in that manner?
Why wouldn't it?
Good question.
I mean, you've got a mandate. It makes logical sense that everyone should be thinking about the mandate as a whole. And in the Future Fund's context, it's about maximising return while taking acceptable but not excessive risk. And there was a return benchmark associated with that maximised return. Why shouldn't everyone be thinking about that? Everyone will make a different contribution to it, but ultimately that's how you're going to be judged. So it just made more sense, I think, for us in terms of alignment to take that holistic approach. And of course, the traditional approach is a bit different, where you have the asset allocation team, which would have been my team, coming up with a portfolio and then handing out buckets of money and having those various buckets be filled by people without reference to the overall portfolio outcomes. But to us, it just made more sense to focus on the whole. I think there are lots of benefits associated with that. All the different groups think about the whole of the portfolio. There's much more idea sharing. You're also looking at the best marginal opportunity. And when you're thinking about the portfolio as a whole and the risks, you're using a common framework to do it. Lots of advantages. Okay,
so it sounds like it worked a treat, but were there any disadvantages?
There are disadvantages. And when I think about this, I think, well, not that many organizations have done this. So why is that? There must be good reasons. And I think the first reason is it's actually quite hard. It's hard to do that because you do rely on a lot of collaboration and a lot of information sharing. And as you get larger, that becomes more difficult. But even if you're not large, I think one of the key challenges is that people think differently. And I carried out a little experiment. I sent a survey to my colleagues across the various asset teams and also my team in strategy, and asked them to choose what portfolio they would choose if they had the choice. So what ideal portfolio would they have? And it turned out that everyone, including strategy, which had responsibility for derivative overlays, everyone chose more of what they did. And you can say, well, okay, they're all biased. Maybe they are, but also they knew more about those particular asset classes. But yeah, it's hard to get away from the fact that people think differently. Big picture people probably don't think about the nuances of some of the bottom-up implications. And if you're a property person, you're probably going to be thinking a bit differently than if you're a private equity person or a debt person. It's just the way things are. And you have to recognize that and have some way for integrating a portfolio where people think differently.
So it might be helpful if you could give us an example of how a decision was made using this total portfolio approach, perhaps an investment that was made. Sort of how did it begin, and what are the stages that it went through, and how does it work in practice?
Well, I won't talk about a specific investment, but I think the thing that is most powerful is when someone comes up with an idea and it gets presented to the investment committee, or it gets debated, and it could be the case that it's something that is particularly attractive at whole of portfolio level. So let's say it's a relatively liquid opportunity. It'll be compared with a liquid proxy, and the expected outcomes could be quite good compared with that proxy. But if they're particularly good, what might happen, and Dave Neal was very good at this, he said, well, why don't we double it? Why are we taking an exposure of this size? At portfolio level, that doesn't mean much. We should actually scale it up. I think the total portfolio approach nudged people in the direction of taking more meaningful positions. So if you're running a particular asset class team, you might not feel comfortable having a lopsided portfolio. But when you're thinking about it as whole of portfolio, you will feel more comfortable with that. And we definitely did do that on quite a few occasions. Likewise, as I mentioned before, the debt portfolio doesn't look like a normal debt portfolio. It's a riskier portfolio. The private equity portfolio doesn't look like a normal private equity portfolio. It doesn't have the large buyout that an average private equity portfolio would have. The alternatives portfolio, which is the hedge fund portfolio, again is quite different from the average. And these things are structured the way they are because they all fit into an integrated whole of portfolio approach.
It's interesting to hear you talk about what happens when you integrate the various parts together, and how the individual pieces may not make sense on their own, but they make sense in terms of what they contribute to the overall outcome. And I just can't help but contrast that to a lot of other investors out there where they review each asset class, say on an annual basis, and they review the equity portfolio, the fixed income, and they look at it just as a standalone piece. And I think what ends up happening when you do that is you end up, in many cases, over-diversifying that piece, because you're trying to manage the risk of that piece instead of trying to manage the risk of the whole.
I think you're right there, and the point there is really it's about fallacy of composition. You want to look at the overall effect rather than focusing on just the micro and the detail. Completely agree with that. Definitely.
And I think also the way that we report information can help. One of the things that always used to frustrate me was when we had to report information that we had to give a lot of detail about individual managers or individual portfolios over short time periods. And I think if you spend more time looking at overall portfolios over longer time periods, that aligns much better with this sort of decision making.
Agree.
Okay, so how do you resource a whole of portfolio approach? What do you need in terms of people and systems?
I think it starts with clarity on what your objectives are, clarity on beliefs, because there has to be that alignment, clarity on the investment framework, the risk framework. So a common language and a common terminology and common purpose. So the culture is very important. At the Future Fund, it was quite simple to describe who we were or who we are. Australia's sovereign wealth fund, investing for the benefit of future generations. People can identify with that. Likewise, there are a few summary statements that characterize the culture. They've been revamped recently, to be things like do the right thing, focus on what matters, work together. Those are very simple things that people can identify with, so people can buy into those things. I guess in the past I really didn't pay that much attention to those sorts of things, but they do matter. You can get that alignment. Then I think when you're talking about common languages and framework, we focus a lot on, I guess, key descriptors. So when we thought about risk, we didn't think of a single number. We would think about things like the overall market exposure. We'd think about different measures of downside risk. We would think about liquidity and flexibility. But those concepts were shared across all the the asset class team. So people thought about those things. People would be involved in, I guess, the whole process. We would start by thinking about the state of the world. We would think about the macro. We would think about possible scenarios. We developed an internal model to take those macro outcomes and translate them into portfolio outcomes. So for all the scenarios, we had different portfolio outcomes. We would assign likelihoods to those outcomes. We would use judgment because you cannot construct a single portfolio that's robust to all those possible outcomes. Now, of course, that didn't really, mean that we're just looking at, historical stuff or forward stuff. There's a lot of judgment exercised. You're looking at, the past. You're looking at what you think might happen in the future. You're not making, let's say a call on what the bond equity correlation is going to be, in the future. You're looking at what will happen to those two exposures given different scenarios. And there'll be times when the correlation will be, positive. There'll be times when the correlation will be negative. So I find it intriguing or amusing that people will say, the correlation switched. I would go back and say, well, what's causing it? Is growth stronger than expected? If growth stronger than expected, then equities will do well and bonds won't. If inflation is higher than expected, then both bonds and equities will do badly. It depends on the drivers, overall supply and demand. So we would look at the macro, look at the scenarios, look at the portfolio outcomes, discuss those portfolio outcomes given those scenarios in our views, and position accordingly.
Okay, so you're integrating views across the portfolio, considering the macro, coming up with scenarios to create this total whole of portfolio strategy. What does that mean for the way that you work with investment consultants and fund managers? Because so much of the funds management industry is oriented around the silos that we all know. So you've obviously taken this different approach, and most managers manage to these silos or asset class benchmarks. How does it translate in terms of the managers that you use and how you invest with them?
Well, before that, I should probably talk about what the different asset class teams, because I've only mentioned the top-down bit of it.
Sure.
The bottom-up bit of it, of course, is that all the teams are going out there and looking at opportunities that they think will be positive for the portfolio. So they've got all their managers. They're looking at how they can access those different exposures. They're maintaining various relationships. They're bringing forward proposals to investment committee. There's a pipeline of things that they think they can do. We're comparing opportunities across different sectors. So at top down, bottom up, all that gets integrated, and there's a vision for how the portfolio will evolve given those opportunities. So when it comes to the managers, it will be, well, how can we find something which is accretive to the portfolio in terms of the return or risk. In the case of, let's say, hedge funds, we wanted to construct an overall portfolio that didn't have any strong factor exposures. It didn't want it to have a lot of equity beta or be strongly exposed to other factors. Certainly, if we were paying fees for those sorts of things, but we wanted it to have a payoff profile that could help. if we had one of those bad portfolio outcomes. When it comes to the consultants, we did most of our work internally, but we would use consultants to reality check the work that we did, to test it. And we also did that with some of our managers. We would ask them from time to time to cast their eye over our assumptions. So really it was there to keep us honest.
Okay. So we know that the Future Fund is such a large and important investment institution in Australia. So it's only natural that a lot of institutional investors look to it for ideas and inspiration. And I'm interested to get your thoughts on whether or not other institutions should be doing this. Because after all, the Future Fund it's a semi-government organisation. It's tax exempt. It manages over 140 billion. It has a large team of expert staff. It has access to deal flow and co-investment projects that other funds may not. It has a large number of unlisted assets that it purchased previously, probably at more attractive valuations. And it doesn't have to deal with competitive pressures or redemptions, at least not yet. Eventually, the government may come calling for some money, although it won't be a warlord in our case. So what can other institutions learn from the Future Fund, and what things carry a "don't try this at home" label?
I think the biggest lessons come from culture, clear mandate, alignment. There are some things that the Future Fund has that others won't have. That is that people want to talk to you. You're large enough, hopefully respected enough, that people will call on you, so you get great access. So that's one thing that stands out that people won't always have. The fact that the staff is really good, but also sufficiently large, means that it's capable of doing a decent amount of due diligence. My former colleagues in the private equity team, for instance, would be forever traveling, and they'd be traveling not because they like traveling so much, but because they wanted to attend the various advisory committee meetings with their managers. And that was great because it gave them insight into what was happening. It also gave them more clarity on the various portfolio companies, and that information got fed back to other members of the investment team. Now, not everyone's going to be in a position to be able to do that. Likewise, the size of the staff and capabilities meant that we could do our own modelling, build our own frameworks. Not everyone's going to be in a position to do that. So a lot of natural advantages. Likewise, when it comes to scale, we're big enough to matter to a lot of managers, which mean and it's long-term capital, which is attractive to a lot of managers. So we're an attractive partner. That means that it's more likely that we can get involved in co-investment. It also means it's more likely that we can get access to harder to access managers. So a lot of advantages. There are things that work against an organization like the Future Fund, and that also comes to scale. While there are advantages with scale because you're large enough to matter to people and you can get access, the flip side is that sometimes you're just too large to take advantage. And if I think about the Australian context, Australian small caps, there may be a lot of value to be had there, but the Future Fund's just too large to really be able to extract value from that sector.
Okay, so it's interesting to hear you talk about the two sides of scale, how it works to your advantage in certain areas such as large unlisted investments, but may work against you in terms of other things like stock picking.
No, absolutely. And it's also quite amusing because it's forever a question, what is the best size? What is the right size in terms of assets under management or in terms of staff? And, when it comes to, let's say, staffing in the organization, a lot of debate around the size, because once you get up above, let's say, 150 people or more, it changes. You don't know everyone. You might be spread over different floors. So the culture can potentially change. You just need to be alert to that. With assets under management, it poses additional questions. There may be only a certain number of managers that you really want to get access to, and those accessible managers may only have a certain amount of capacity. So you may not be able to scale the business model once you become larger. But likewise, as I mentioned before, if you are sufficiently large, you can become more attractive, to other participants, and perhaps there are other things you could do that you might not have been able to do otherwise. But in the limit, of course, if you get very large, you look much more like the market.
So it sounds like what institutions should be doing is coming up with a framework to sort of assess where they're at and what is attractive for them given their size and resources.
I think that's right. But I think, of course, they need to be very clear about what their overall objectives are.
I think that's a good point. It all goes back to the objectives. And as you pointed out, the Future Fund essentially has one objective, whereas most institutions such as superannuation funds have somewhat conflicted objectives because they do compete versus other funds. So while they often create products around a longer term CPI plus objective, there's always this eye on what peers are doing and how they rank in a survey. So it's I think that is an underappreciated topic of just how beneficial it is to have a single clear objective rather than dividing your attention across multiple objectives.
I think that's true. But of course, the Future Fund, the agency, manages a number of different portfolios. So the nation building funds, there's disability care, medical research future fund. So those funds may have slightly different objectives, but all of those objectives are clear.
Mm-hmm. Very good. Okay, so we've taken a walk down memory lane talking about your career up until this point, and we mentioned at the outset that you left the Future Fund in April of this year. Where to now for Stephen Gilmore?
Look, I'll stay in the industry. I will be in a role where I can influence portfolio outcomes, and it will likely be at scale.
Okay. Well, we look forward to seeing where you end up. So we usually ask our guests a couple of concluding questions, and they are, what are 3 practical steps that investors can take to improve their investment decision making?
But these things are common sense, I think. First, you should be clear about what you're trying to achieve. I think second, be very clear about what your risk appetite is. And third, be realistic. And I mentioned that last one because quite often people will look to the past and say, average returns have been X. But with real interest rates as low as they are now, and risk premium where they are, prospective returns in the future are going to be lower. I think people just need to be realistic. So I think those 3 things are the things to focus on, but it's really common sense.
That last one about being realistic reminds me about an article that Warren Buffett wrote many years ago where he talks about the problem of the Triple Crown winning horse. He said if somebody was to tell you that this horse won the Triple Crown, you'd think it's an amazing horse. But if they also told you that the horse was now almost 20 years old, well, you probably wouldn't bet on it, even though it had won the Triple Crown. So you need to handicap history based on what you know of the circumstances. And as you point out, a lot of people make the mistake of just taking a historical record and not handicapping it for what they know about the present. So what are some pieces of research or books or ideas that you think our listeners might find interesting?
These are things that I guess people have probably read, but one I go back to from time to time is a piece written by Howard Marks, Risk Revisited Again. Excellent piece. And it's always good to just remind yourself that risk isn't a single number, but Howard Marks is extremely good at the narrative.
He's got a new book coming out later this year, which I'm keenly awaiting.
I would also highlight Super Forecasting by Tetlock and Gardner. They talk about foxes and hedgehogs and big ideas, and really just looking at the data and recalibrating. But I think that's quite important in terms of being a reality check. And we talked a bit about AIG. A lot of words have been penned on what happened there. But I think the best book that I've seen is one by Roddy Boyd called Fatal Risk. He did his homework, had good sources, and it's a pretty good summary of what went on. Told well.
Okay. Well, thanks for the tips. I'll have to look up that last one to add to my library. Well, Stephen, thank you very much for spending the time to chat with us about your very interesting and varied career, and we wish you all the best for the future.
Thanks, Daniel.
Thank you for listening to the i3 podcast. For more information, please visit www.i3-invest.com. Thank you very much.